Guys, these are 3 stocks selling at or near their 52-week low. Stock number 1, Cisco, currently selling for about $46 per share. Guys, year to date, down 9%, 1 year down 3.5%. Everything up to 1 year down, even more so, 5 years down 14%. Now, why do I love talking about Cisco? If you've watched our channel before, you've seen me do this. The all-time high for Cisco, March 7th, 2000, $82 per share. I always say, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. So, what does that mean? This was the company that was supposed to be the first trillion-dollar company in the world. It hit $500 and some billion market cap, went down from there. So, you're probably thinking, yeah, but Paul, the revenue's down, the profit's down. Hold that thought. Let's go to our income statements. Let's go back to 2000. And luckily with our software, we have everything up to date right here. 2000, it did $18.93 billion in revenue. It did $55 billion in the last 12 months. That's almost 3 times more money. Actually, that is 3 times more money. What about profit? The year 2000, $2.67 billion, $12 billion in net income. Almost 5 times more profit. Even more so, back then, 7 billion shares outstanding. Today, only 4 billion. So not only is the business bigger by almost 3x, the profit's up by almost 5x, but the number of shares are down 33%. So they're dividing that revenue, profit, cash flow by less shares, which should drive up. But the stock still has not hit its all-time high. Does that remind you of what's going on right now in some areas? Just because it's down that much, though, I don't want you thinking it's not a good investment. Let's check out the 8 pillars. Guys, look at this. Apart from one, it's a 7-check business. Now, cash flow is down $2.4 billion versus net income being up, with revenue up $4.8 billion. So this is telling me the story of, okay, why is cash flow down so much? I got to understand that because everything else looks pretty good. I'm actually surprised they're not buying back more shares. So I'm going to go right to the cash flow statement and look at the last. Why is it down so much? All right, well, it doesn't look awful. There's a slow start right here. Changes in the working capital really drove it down right here. All right, so it might actually not even be that bad. It could very well be an 8-pillar stock. Let's see what the analysts are saying, because guys, remember, when it comes to looking for value, one of the first places you should look are stocks that are near 52-week lows. Doesn't mean they're a value at that price, but it means take a deeper look, see what's going on there. This company, not much growth for Cisco, earnings per share, not much growth in revenue. It's kind of a boring company, but remember, if you pay a cheap enough price for a boring company, you can do well. Not only that, this boring company has a pretty good return on invested capital. And I'm hoping that their price to free cash flow drops. Why? Because I want them to buy back a ton of cheap shares. That's what I want. You have a $186 billion market cap. Enterprise value is $245. So a big difference here of $60 billion is their debt. But they have a lot of free cash flow here. They're still generating a lot of free cash flow. All right? So I don't want everybody just sitting there and looking at it going, oh, but it hasn't had an all-time high since 2000. Well, guys, what matters is not where the company has been for stock price. What matters is what are the fundamentals saying about the future and what price are you paying today for that? These are amazing lessons to learn because Cisco is not the only example of this. Not the only example of this. So let's go check out our stock analyzer tool. When was the last time I did Cisco? So 10-year analysis. And remember, this does not include the balance sheet. I did 2, 3, and 4% revenue growth. Guys, it actually might be high because look at the last 10 years, 1.6, last 5 years, 1.5. Let's do this. Let's go 0, 2, and 4% revenue growth. Profit margin, 22 and 2 and 24. Free cash flow, 24, 28, and 30. Look at how much higher their free cash flow is over the last 5 and 10 years. Now, finally, PE ratio, 12, 14, 16. I can understand if somebody said, no, Paul, high return on invested capital, it justifies higher. Okay. I can understand if somebody else said, yeah, but Paul, it's a declining business. It's not really growing very much. Maybe the P should be lower. Okay, I get that. That's the reason why you need to put your own numbers in there. And you might know more about Cisco than somebody else out there. And if you're in our community, please have a conversation about Cisco, because I do think it's worth looking at. The other thing is they pay a 3.5% dividend, and it doesn't eat up. It only eats up $6.5 billion of their $14 billion free cash flow in the last 5 years. So they're not even exhausting their free cash flow by giving a dividend. If this company were to fall in half tomorrow, I would pray to the investing gods above, Charlie Munger standing up there, and I would say, Charlie, please get the board to cancel their dividend and use 100% of their free cash flow to buy back super cheap shares. That's how you give investors a ton of money. All right. So back to the stock analyzer tool. Again, made these assumptions, hit the analyze button. Boom. Low price 30 to 36, high price 56 to 70, middle price of 40 to 52. I have my watch list at 44, not to buy it there, but to sell puts at lower prices. Today, based on today's price of $46, if my middle assumptions occur, our discounted cash flow model gives you an 11% return, and that includes the dividend. But I think based on Cisco not being a growing business, get a little more meat on that bone. Be a little more conservative. Stock number 2, Air BNB. This company has fallen a lot lately. The stock is up to 115. All-time high was 220. Actually a long time ago. February 11th of 2021, 3.5 years ago, it hit its all-time high. That's incredible. I'm actually surprised by that. All right, $75 billion market cap, $82 billion enterprise value. But guys, let me show you something here on the balance sheet that's very interesting. Let's go to this balance sheet. They have $22.5 billion in current assets. $22.5 billion in current assets. Total liabilities, $18 billion. Wow. So this is an example of where the pillar of long-term liabilities divided by free cash flow isn't telling you the whole story. But for right here, you've got essentially $22.5 billion in cash and $18.5 billion in total liabilities. That's a very good balance sheet. Air BNB shocked me when I saw this. I was like, okay. Now, 8 pillars, a lot of X's here. Young company, growing. Look at this 5-year PE, 168, 5-year price to free cash flow of 32. Look at the difference between free cash flow and earnings here. The 5-year free cash flow of $2.34 billion, 5-year net income, $443 million. So focus here on the cash flow. The good news is the free cash flow last year was about 12% off of their net income, but it's growing and getting better. Look at this growth rate. 5-year revenue growth, 22% per year. 3-year revenue growth, 33%. Gross margin, 82.6%. That's incredible. $10.5 billion in revenue with $4.8 billion in profit. That's freaking unbelievable. That's insane. A 21% return on invested capital last year. 17 times last year's free cash flow. They just reported they see weakness happening, but they still have 9 and 10% revenue growth, bookings growth, nights stayed. It's still a growing business. And I love the model. Now, guys, it's really, really important that when you buy these companies, that you really do enough investigation to really understand the numbers, most importantly, in my opinion. And then from there, if the numbers make sense, the story along with it. Now, if you go to everythingmoney.com, you'll see we have a limited number of daily spots for the community and software because the community is a great place to have conversations about investing. And the reason we're limiting the spots is the software as it exists today currently includes everything we have to offer involving stocks, real estate, and retirement. All of these tools. But now we have 4 real YouTube channels. And behind the scenes, we're making some really big changes as we continue to expand and give you a better experience. These offers are going to be separated and going away very soon. Now, you may remember when I first started the channel, I built the software selfishly for myself so that my team and I could use it to constantly make better decisions in all aspects of money investing. I'm involved in real estate. I'm involved in stocks. And I think about retirement, even though I probably won't retire. But the channel and the community have continued to grow immensely since then. So it's becoming more about you and the community and less about me. I need to be able to serve you guys better. Now, the good news is these changes haven't been made yet. So if you join today, you'll be grandfathered in for life with all the data, all the tools, and every future tool we make from here on out. You'll get all of it and you'll get it at your price forever. This is the best deal we've ever offered. So if you're serious about making better financial decisions, getting better returns, and more importantly, sleeping better at night, click the link in the description below to get access to everything we have to offer. Everythingmoney.com/sign up. I guarantee it'll be one of the best decisions you ever made. So let's go to Stock Analyzer. Let's go to analyst estimates first. Guys, they have them doubling their net income in the next four years. And actually, it makes, such a high gross margin, 85% gross margin. That means every extra dollar they sell, 85 cents is essentially profit before overhead and their taxes. That's incredible. That's higher than Microsoft. That's higher than Palantir. That's higher than NVIDIA. That's higher than Google. Guys, that's hard to find. Revenue growth, low double digits, pretty solid. Pretty solid stuff. Like everybody knows Airbnb.com. Everybody knows it. Everybody looks at it. So let's pull up the Stock Analyzer tool. Last time I did it was yesterday. Now, this doesn't include the balance sheet, which has that positive effect because of cash on hand and total receivables. I did 4%, 7%, and 10% revenue growth. But remember, I did this over 10 years, not the 4 years we had in our analyst estimates. I did profit margin. Guys, this could very well be very low. Oh, let me do this. I'm going to do 20, 33, and 45%. Okay. Guys, I don't know. We don't have enough of history to see the profitability. Because look, in the last 5 years, profitability has been 3.3%, but free cash flow has been 35%. So I'm doing 20, 33, and 45%. This could be absurdly low. This could be low. This could be right. But that's what the issue is with newer companies. We don't have a track record to see how would they operate. That's where you need to do more due diligence in the community, having that conversation with people, digging through the 10Ks as a group together. Now, PE, I did 14, 16, and 18, and 9% desired return. Hit the analyze button. Guys, look at this. Low price of 51, high price of 212, middle price of 115. So it's probably selling about what it's worth right now, in my opinion, according to my assumptions. So I'm just going to wait to be a little bit more patient. I'm going to add it to my watch list at $85 a share, not to sit there and buy it then, but maybe to sell puts. And the software will notify me because I'm a member of it. Okay. So that's Airbnb. Stock number 3. You know what? I think we're going to do 4 stocks today. I'm going to do a little bit extra for you. So stay on for the 4th stock. But stock number 3, John Deere. Stock's at $348 per share, all-time high of 450.00 on the nose, July 25th, 2023, a little over 1 year ago now. So we got a 10 PE here and a 19 price of free cash flow. Guys, one thing I don't like, look how different the free cash flow is from the net income. We have 1 year free cash flow of $5 billion, 5-year average of 3.3. We have 1 year of net income of 9.5, 5-year average net income 6.4. Not going to lie to you guys, I'm probably just out right now. I know that might sound crazy, but I just don't like this discrepancy. Unless I do a lot more research, I'm basically going to be like, well, why do I want this? I mean, they're eating up a lot of this. Why is there such a big difference between free cash? I don't like that kind of difference. It's always going to have me worried. And people are going to focus on this 10 PE so much. So for me, it's like, do I really want to do that? I know that's kind of abrupt, but I look at the saying, it's really important to me that their free cash flow, it can't be this different. This is a huge difference. This is half almost. Half the free cash flow from the net income. And by the way, if you disagree with me on that one or you have an explanation, love to hear it. My goal as an investor is to quickly say no when something just rubs me the wrong way. That rubs me the wrong way. So stock number 4. This one's a very, very popular conversation recently. That's probably my riskiest stock. Intel Corporation, big fall down to $20. Guys, I own the stock. I don't have to tell you this. Don't buy a stock just because I do. I'm down 40% of this bad boy. I've been saying for a long time, this is a turnaround play. If you don't have the stomach for a turnaround, don't do it. I have enough invested where if it works, it's going to be nice. I have enough invested where if it doesn't work, it goes to 0. I'm going to be fine with that. I don't think this company's going to 0. In fact, they've just been beaten up lately, I think, by a lot of poor performance. Don't get me wrong. They missed on earnings big time. They were supposed to report 10 cents per share in profit. They reported 2 cents. It's not good. It is not good. But I'm hoping that the Intel brand, which is still a great brand, people still use it synonymously with quality. As the chip industry rises, so will Intel. Their revenue is down a lot recently, but it's coming back as we speak. The question is this an example of the market, Mr. Market, giving you a bad price because he's depressed about a company? And guess what? Intel, just like Cisco, look at that. All-time high, $75 per share back in 2000. If I had told you back then that the company would have more revenue, more profit, and the stock would be down, 70%, what would you have said? More than 70%. You'd be like, there's no way, because Intel, go look at it. Intel and Cisco were the companies back of 2000. The reason I say this is the same will be said 20 years from now on some of the companies that are flossing today. They're going to be saying, you're an idiot for owning that company. Why are you so dumb? Because that's what I hear now about Intel. Understandably so. Understandably so. This is a turnaround play. This is a tough one. A lot of negative cash flow. They're investing a lot of money into plants. They're building 3 plants, Ohio, Arizona, and Germany. This is going to their foundry system to build chips for other people. It's going to be a tough one. If you don't have the stomach for it, first off, you don't have the stomach with stocks anyway, but this is going to be even harder. The question is going to become, is it really worth it for me to stick around for this? Because what's it really worth? Let's go to our stock analyzer tool and see. First off, let's go to analyst estimates. Analysts think that the company's going to be making $5 a share in 4 years. If they're right, and you multiply that by 18 times, that's a $90 stock. 20 to 90 bucks in 4 years, if they're right. The question is, are they going to be right? Revenue? Revenue is down big time, but they have them growing back to $93 billion in the next 4 years. Are they going to be right? We don't know. But let's go to stock analyzer tool. I'm just going to show you very quickly a recent assumption I made. 10 years. Guys, I'm not even assuming the analyst revenue growth. I said 0, 2, and 4%. Analysts are doing much higher than that. Profit margin, 14, 18, 22. Keep in mind, stabilized a few years ago, they were doing this all day long, 22%. So I'm doing even lower than before. 12, 15, 18 on the PE and price of free cash flow and 9% return. Guys, one more reminder. If you want to have a conversation about this company, $7 for 7 days. Click the link in the description below. Join our community. Join our software. It'll be the best decision you made. Hit the analyze button. Low price of 20, high price of 52, middle price of 33 with quite the low assumptions. I appreciate your time. Have a good one.